Today, folks, we're hopping on that Finfluencer merry-go-round to look at the drama the OG, the legend Ben Felix is stirring within those covered call dividend investors out there. He posted a great video about how covered calls, what people still get wrong, that we are going to react to. We're going to react to the comments on Blossom. 196 damn comments. Absolutely blistering amount of attention here that we just got to dive into. And I get Ben Felix, and I think, and I'm hoping that this is putting the path forward for newer self-directed investors that are going, away from the traditional advisor path that hopefully guides them in a way that doesn't detriment their long-term returns. So I figured it was healthy to react to this. So if you're on a path to financial independence, if one day you'd like to retire early, join me, hit that subscribe button. Let's start with the comments here first and foremost. Levi, I agree with you 100%. However, people are set in their ways and enjoy seeing their monthly distributions. It's not tax efficient and underperforms. Its upside is capped, yet people will still buy them. My 800K portfolio generates me just over 8K in dividends, but where's the fun in that? Some can have a 100K portfolio and generate 20K per year. They only want the psychological feeling of getting paid, but not the realization that they are severely underperforming. I completely agree with you as well. And to those who aren't willing to change, that's fine. Most of them have blocked me anyway. It's quite funny. Mr. Financial, a favorite of mine out here, who's been kind of combating on Blossom, the covered call clowns. I don't know if this video will help those with cognitive bias, such as confirmation bias or wishful thinking. It will help with the newbies for sure, and that's who we all want to help, and I agree. That's why we're making these videos. It will not help those that have made CC ETFs their life. It's like a degenerate religion, and they just think that, like, oh, this old finance, it's like trying to reinvent the wheel. It's like covered calls have been around forever, and they just don't want to admit when covered calls are appropriate to utilize. They don't talk about cash secured puts. They don't understand options, I think, in true reality, and that's why they're getting taken advantage of, making these new ETFs billions of dollars. It's kind of disgusting how big they become, kind of bolstering these yields, but not talking about total returns. We seem to forget that providers don't care about us. They just want us to invest, and will use any legal or barely legal method possible, like using Blossom and other social media influencers to promote their products. Some financial products suck, and I'm a guy that's not even really against covered call ETFs. Like, I think they can serve a purpose to an extent. I'm like not like 100% against them. I'll talk about that more in a moment. But yeah, I like Mr. Financial. I think he's pointing out some true facts. Reading into this one, is it true that Adriano spoke at Blossom event in Toronto? The event that was heavily sponsored by Harvest? Yes, he did. Blossom needs to make money somehow, but I wish they could point out the risks of these funds a little bit more clearly so people don't take their silence as an endorsement. Look, I don't really care. Take sponsors all you want. I just wish people were more aware of why it's so detrimental to build out an entire covered call ETF portfolio. And I think Adriano's doing a real disservice to people that have been detrimented through their financial careers, like this lady talking about a testimonial like this is a great thing for some reason. Again, I'm going to be very careful here because I just feel like Adriano doesn't point out risk. He's not a financial advisor, neither am I. So take that with a grain of salt for entertainment value. But this poor lady had a horrible experience with a financial advisor that only made her like 3 or 4%. So she decided to forget financial advisors when it probably would have been healthier to find one that was more in line with, forward thinking and building out a proper portfolio. But instead she went down the self-directed path and then had the cojones to come on Adriano's channel and share it, where 34% of this lady's probably knocking close on her retirement. I watched the video. She said she's reinvesting all the dividends. Everything she's saying is just so psychologically detrimenting to me as somebody that wouldn't put more than 5% of an individual stock in their portfolio. I think it's held more than 20% of a total portfolio in high risk investments. Yet she's got 34% of her money in Tesla. She's got nothing but covered call ETFs and things like Bitcoin. Like, just my Lord, guys. I cringe so bad when I look at this because I'm like, my God, I mean, if we ever go down into a bear market, these people are so screwed. These high risk, high volatile investments, especially mostly like covered call side of things, where these things cap upside, guys. They get all the downside, not all of the upside. And if we go into a full blown bear market, these things do not recover nearly as greatly. And you should always focus on total returns regardless of market conditions, guys, because trust me, you'll get just as destroyed in these covered call ETFs. I'm telling you that. And you're going to pay massive yields to underperform. It's just a fact. It's just a fact, guys. Reading into a few other one of these, though, we got some of the actual delusional people in here, which I always feel like, and it's sad, are people that maybe didn't save enough for retirement, or for some reason they just think that they're getting these crazy yields and they bolster them to their audiences. Like, look, I make 30% a year, and then at the end of the year they actually only came out making like 8%. it's kind of like dehumanizing to the rest of the investors out there that are actually trying to build out a long-term sustainable retirement portfolio. But in my honest opinion, he's damaging his reputation as an unbiased trained investment advisor who is supposed to be open-minded on any asset class of regulated investments for the interest of his clients. Okay, does this guy even like listen to what he's saying? When we watch this video, the guy is literally going through the actual facts. Why are you trying to reinvent the wheel with something that's already been around, acting like this is some new investment vehicle? It's like, it reminds me of like NFTs. Like, it's like, this is going to revolutionize everything. And then no one gave a crap a year or two later. But to paint an entire class of federally regulated investments as a sham, really, it is exactly why I left old traditional minded bank manager advisors. So you're going to sit here and let YieldMax promote 80% yields, and this they don't return that. Like, they'll never return 80% yields. Like, they're volatile as hell. Like, you're telling me that's not a sham? You're really not telling me that there's something kind of peculiar going on when they're playing in the interest of dividends and they're really just showing you a yield and shunning you from the total return? Like, how delusional, Perry? What are you talking about? It is exactly why I left old traditional minded bank management advisors. This is another guy that got butthurt from a really crappy advisor. Meanwhile, Ben Felix is really just spitting facts. Personally, I won't play into any of these FUD story in YouTube clickbait videos. Really, I mean, Adriano, if you go on his Blossom, it's just, look how I make this yield, guys. Look at my yield. You really have to dig, though, to see my shitty total return since I've been investing. But look at my yields, guys. What are you talking about? This, I just hear all of these stories from these, and I do respect and follow. And the quiet chat from my industry experts that don't understand the motivation, taking closed-minded and extreme beliefs so public. How is it an extreme belief to try and gear younger audiences toward index investing and like diversification and global market diversification over dividends? Where, like, as an example, guys, I sold SCH. This is like the least extreme understanding of this. Companies that generate dividends, and let's be real, covered calls are not dividends, guys. Like, they're you're selling contracts. It's not even true like investment style investing. It's crazy in the sense of the way these guys are doing it. Regardless, I sold SCHD during the Terrafor, and I pivoted over $100,000 of SCHD into the S&P 500 because I recognized I wasn't utilizing the dividends. They weren't helping me because dividend-paying companies are traditionally a lot older, mature companies that don't have a lot of growth. And as a 30-year-old investor, it just seemed insane to me to be chasing yield. So I put it all in the S&P, and I'm up 25%, whereas if I left it in SCHD, I'd be up 5%. Horrible, I know, cross-examination here because we're talking about covered calls, not traditional dividends, but facts are facts, results are results. I'm not saying you can't perform with covered call ETFs. The fact is you underperform. And for some reason, you're okay with that, paying someone a higher yield to underperform because you can't hit a sell button, which means you should probably hire a financial advisor because these delusional nutcases would rather just own shares that deteriorate over time than actually sell off shares, right? Because they're like, oh, in a down market, you still have to sell. In a down market, your covered call ETF will be down probably just as much. And guess what? When the market recovers, you ain't recovering with it. I prove mine to my followers and subscribers with real facts and real results over and over again. They just can't get past the fact because they're making money that they're not like detrimenting themselves. That's the hilarious reality of this. So let's just listen to this and get some reactions because obviously my opinions are pretty darted toward the reality of investing, which is I'm a value investor. I want to buy the best possible businesses, hold them over my time until I need the capital, and build the biggest cash pile possible with the best stocks. And yes, there's going to be volatility. You can't get away from that by buying covered calls. I'm sorry, but just they think they can because they think the market goes down and the premiums cushion some of the blow. And then when the market recovers, they get none of the upside. Guys, we've been in a 15-year bull market. Over 20 years, the markets have always offered a return. Again, I'm not saying you can't have a piece of these for your retirement portfolio to maybe boost some yield, but it's insane to do what this lady's doing. Like, look at this. Is someone gearing toward retirement? This lady's probably in her 50s. It's like, are you insane? Call him the Dave Ramsey, for crying out loud. Talk to someone with some brains, not these finfluencer clowns, right? Including myself.
And it is increasing, not decreasing the risk of your ability to pay your bills in the future. Remember, covered calls look a lot like holding a large portion of your portfolio in cash. That can look good over some periods when stocks perform poorly, but in the long run, it is expected to be very expensive. Another interesting question is whether reinvesting rather than spending the distributions gives covered calls a magical advantage in a market downturn, as Andy suggests in a comment. As you can see here, with dividends reinvested, it does not make a difference to the general story. Covered calls continue to dramatically underperform when both sides of the comparison are left to accumulate and reinvest their distributions. One of the
Before we get deeper into this, I just want to say too, right? Like the dividend investing is a psychological way to keep people invested and keep going. And I get that, but it is still true, like a bias of detriment. And I'm always really annoyed of this dividend snowball idea. It's quite a delusional way of building up a portfolio over a long period of time. And like he's saying, like, yes, you can still make money, but the money you're leaving on the table and those few extra percentage points over 10, 20, 30 years could be the difference between you having millions of dollars and hundreds of thousands of dollars. Like it is truly an insane fact when you have time to compound it.
Mistakes I think a lot of people are making with these products is thinking, as Andy suggests, that covered calls allow you to spend more in retirement or retire sooner with less savings. The only way this is true is if there was no other way, psychologically speaking, for you to spend your own money. That aside, covered calls result in a lower, not higher sustainable spending for long-term investors for the simple reason that they reduce expected returns. Addressing the questions about when...
And that's the reality of it, right? Like they're told they're getting 20% yields. The real rate of return over long periods, depending on the underlying asset, could be like 8, 10, whatever percent. Meanwhile, if they just bought the underlying asset, they would actually have a lot more money to spend in retirement. But again, it's just some weird psychological dilemma of not being able to hit the sell button and realizing, like, even in down times, guys, a premium doesn't save you from still seeing your assets go down. But they're like, oh, my portfolio loses 20%, I'm still getting the same income. It's like, you're not really though, right?
Covered calls may or may not shine was important. There were also a ton of comments from people claiming that I picked the wrong funds to analyze in my previous videos. The interesting thing to me is that most of the tickers that people offered up as superior performers and better representations of covered call funds as a strategy have similarly underperformed their underlying equities. These repeated interactions led me to believe, with all due respect to everyone watching, that many investors have no idea what their investment returns actually are.
And I agree. I don't have any respect for these people, and I'm a clown on the internet that for entertainment value doesn't mind saying so. They don't talk about total returns. They rarely do, and you have to dig very hard through their videos to even find it. The thing they will show you over and over again is my distribution of 20 to 30% on my 400K retirement portfolio. And it's just, I feel bad. I feel like some people have undersaved for retirement and they think this is some quick path to a fix when there is no quick path. There's no reinventing the wheel. I'll talk about covered call strategies in a minute because they just don't talk about them, or cash secured puts or any of that. It's just, I find it crazy.
And that is an observation backed up by academic research. People really don't know what their returns are, which makes it hard to make good decisions. Let's go through all the examples that I was given. These first ones are US listed ETFs. SPYI, the NEOS S&P 500 High Income ETF, has trailed the Vanguard 500 Index Fund by 4.61% annualized since August 2022. Not off to a good start here. QQQI, the NEOS NASDAQ 100 High Income ETF, has trailed the Invesco NASDAQ 100 ETF by 2% annualized since January 2024. Not as bad. JEPQ, the JP Morgan NASDAQ Equity Premium Income ETF, has trailed the Invesco NASDAQ.
What you'll realize is they'll look at some of these charts and see, like, see, they're almost exactly in line. And these things have been around for such a short period of time, and they're just starting to trail. And some of them are using leverage, so it requires these up into the right markets to maintain that, right? But if we ever go down, that leverage is going to completely destroy your returns.
100 ETF by an annualized 4.36% since May 2022. To its credit, in the 2022 downturn, JEPQ did better than its underlying, but any advantage was short-lived as it gave up the upside in the subsequent recovery. Okay, DIVO.
And I know in this video they're going to completely say, see, in a down market, you actually do better. And it's just like, guys, you can't predict down markets. You're going to severely give up all of that return just because you're waiting for that one downturn we haven't significantly seen in 15 years, and maybe the pandemic, maybe the 2022 financial crisis, but we're in the biggest bull market in human history, and they just don't want to admit it.
The Amplify CWP Enhanced Dividend Income ETF, if I have any integrity. I had to put some effort into the underlying comparison here since DIVO is not an index fund. It holds a portfolio of high-quality dividend-oriented stocks. So it doesn't make sense to compare it to, say, an S&P 500 ETF. I compared it to the Vanguard Dividend Appreciation Index Fund ETF. They have moderate holdings overlap and a very high return correlation, so I think it's a reasonable comparison. DIVO has underperformed by an annualized 51 basis points since December 2016. I know I said an S&P 500 comparison made no sense here, but DIVO has performed far worse against that benchmark for whatever that's.
So I will say, like, even with my parents in retirement, I have no problem with making a small percentage of your portfolio as ETFs, but for the lack of upside potential, we can't obviously weight them to any extreme level. And Devo is actually one that I've recommended on this channel. I think it's one of the better ones. I think some of the ones that are written against the Canadian banks here in Canada, like they can serve a purpose, for more passive oriented yield income portfolio. But again, guys, total returns, even with my parents in retirement, I told them you'd be delusional to make an entire portfolio of this because you're going to give up the upside. My mom was able to purchase an entire vehicle off their like S&P 500 returns alone. And I just said, like, there's going to be periods where growth underperforms. You can lean into the dividends, and then the periods where again, it comes back to the point of capturing the total market. That is what these delusional clowns don't understand. When you're investing and building a properly diversified portfolio, you need to look at growth in income, international markets. You need to encapsulate that. And again, going back to this example, this is insane to me. Like some of these ETFs and the way these people invest, I like, my heart wants to blow out of my chest.
It's worth. QQQI we did earlier, another underperformer. At least I still have my integrity. Okay, income and growth. Let's take a look. HYLD is the Hamilton Enhanced US Covered Call ETF. This is a Canadian listed ticker. Let's keep in mind that this fund does have a modest 25% cash leverage. It aims to be a higher yielding alternative to the S&P 500 with similar volatility, so I will compare it to an S&P 500 ETF hedged to Canadian dollars since HYLD is also hedged. It has underperformed by 0.9% annualized since February 2022. HDIV, the Hamilton Enhanced Multi-Sector Covered Call ETF, is a portfolio of primarily sector covered call ETFs with a sector mix intended to be broadly similar to the S&P TSX 60. It has beaten the S&P TSX 60 as proudly proclaimed on the fund website, but this fund has a third of its assets invested in US equities. To make a proper comparison, I did my best to reconstruct an index fund portfolio matched to the underlying equities of HDIV. My model had no leverage, while HDIV has cash leverage of 25%. My model outperforms HDIV since inception. Properly benchmarked, I don't think this fund is beating anything. It's levering up for more downside volatility and still underperforming.
So again, these guys are going to look at this and just cry wolf about how great the returns have been because they're just making money, and they think because they're making money, it's an acceptable way of investing. And again, in retirement, you could make some claim for that. But like he said, if you still plan on living for 20, 30 years, you want to be able to capture as much of the upside as possible because you're just leaving so much money on the table from traditional, not reinventing the wheel kind of investing. And I'll share with you in a moment, like what I would consider a better covered call strategy.
There is an interesting discussion point here. This fund and its underlying equities are different from a Canadian market index and a US market index, and they have beaten both since inception. I would tend to say this type of short-term performance is unlikely to repeat in the long run. The evidence against active management's ability to beat the market in the long run is absolutely overwhelming. I would approach short-term performance like this with extreme caution. And note that if you believe...
One of my biggest things, guys, and it's another reason that I said Devo, look for the ones that have been around for a very long time. Most of these ETFs these guys hold, including like Pi here, like the passive income investing guy, they're mostly ETFs that have barely existed for any period of time. And you can tell that they're buy and hold investors, but they're trading in and out of these ETFs all the time because they think there's better strategies and all this. And it's so convoluted when investing should be so much simpler than this, guys.
Even this specific sector and country mix, getting exposure to it without covered calls would be cheaper and have higher expected returns. The same thing goes for HHIS, the Harvest Diversified High Income Shares ETF. It is an equally weighted portfolio of 15 trending companies using covered calls and 25% leverage. This fund has not been around long, and for the first few months of its life, it only had 9 holdings. All of its holdings are single stock covered call ETFs from Harvest. I ran the portfolio of underlying stocks with no leverage and no covered calls. My weightings won't match perfectly, but I find that the underlying stocks have performed about the same as the fund. In other words, you were not any better off from the leverage and covered calls in HHIS compared to just owning the same stocks directly over this relatively short.
But they'll think they're better off because they got paid out. They got a tax inefficient payment. So they think they're doing better.
Period. If I allow 25% leverage for the underlying stock portfolio, it has outperformed HHIS significantly, which again is
Again, like instead of using the leverage on the actual covered call ETF, if you just use leverage on the regular holding, your returns would be so much more exaggerated to the upside. You'd be way better off.
What we
Not
should
that I'm negotiating leverage. Don't use leverage. I'm not a leverage guy.
expect when the effects of covered calls are isolated. Now, to be fair here, HHIS has beaten indexes like the NASDAQ 100 and the S&P 500, but let's keep in mind that we are talking about a fund that has existed since January 2025, has had as few as 9 holdings, and currently has only 15 holdings. It would be exceptionally rare for a concentrated portfolio of attention-grabbing stocks like this to deliver outperformance over an extended period of time. The vast majority of professional active managers underperform index funds in the long run. I see people online putting their faith into these products, and I find it really concerning. I honestly hope I'm proven wrong. But at the very least, I hope that people recognize the risk they are taking. This is not a free lunch. Okay, that's the full tour of performance comparisons.
Yeah, and I just want to finish off by saying, if these guys, I'll be Ben Felix right now. You like that? You like that? I guess I'll be Ben Felix for a minute. So when it comes to covered calls, you need to understand that they're tools that you can utilize in a toolbox, right? Let's say I own Google stock and it ballooned up, and I'm up 50% on it this year, which I am. And what I can do is say, hey, it's now well over 5% of my portfolio. I want to shiver off maybe 2 or 3%. Let's say it's 8% or something, right? And what I can do is I can write a covered call and sell it at a certain strike price to someone. So if it reaches up anymore, my shares will get called away. So I'll get paid out for those shares, and I'll have collected a premium, which is the dividend you get paid from covered calls, basically to give somebody that right. So it's I can make extra money on shares that I think are overvalued or I have too much exposure to. Same in the reverse with cash secured puts. A lot of people here, I can't believe, do not talk about puts when it's such an effective strategy toward looking at companies that you may own, that you might want to own more of at certain prices if they drop, and you can collect money waiting for that price to come to. And if it doesn't, at least you cash flowed, right? These are actual tools that have methodologies behind them, and somehow these ETFs that you see here have really just, taken it to an extreme because of the delusion of those dividend yields rather than focused on those total returns. My entire yield off my portfolio, guys, is 1.7% between my fiance and I don't care about the income because I care about getting exposure to the best possible companies in the world and the best possible assets. That is the only conversation you should be having at any aspect of your life and investment, and building a diverse portfolio, as somebody that is a finfluencer clown that you should not take financial advice from. But I do recommend that if you're not capable of managing that in a correct way and pulling capital off and selling shares in retirement, you need to hire a financial advisor. Do not listen to us, guys. Don't listen to these guys. We're all a bunch of clowns. For some reason, I'm the only one that's willing to admit it, but I'll pass that question off to you. I'd love to know what you think in that comment section below.